Good morning, everybody. Good morning and happy Thursday. Happy Pi Day, everybody. Today is March 14th, 3.14, 2024. Top story this morning, another hot inflation print. Yet another one. Sorry, all you Fed pivot guys. I know you're thinking, oh, any day now, they're just going to start cutting those rates. Remember just a few weeks ago when everybody was like, March, man, they're going to cut in March. Zerpenberg is coming back. Dovish Fed, free money for everybody. Number go up. Well, that's gone. March rate cut totally off the table now. Looks like a May rate cut is totally off the table now. And June is even becoming questionable. Case in point this morning, we got the Producer Price Index, or PPI. That measures inflation further upstream in the supply chain, right? It's not as popular as CPI or the Consumer Price Index. That measures finished prices. That's the one the market pays attention to. And then there's PCE, personal consumption expenditures. That's the one the Fed likes to pay attention to. So PPI is another further upstream measure of inflation. Well, that one came out today, and boy, was it hotter than expected. The number came in at 0.6% month over month. That is double what the market was expecting. Market had expected 0.3% month over month. Largest contributors were energy and services. Energy had a little bit of a price spike. A lot of people maybe didn't notice the energy increase as much because energy is spiking off of some pretty historic lows here, especially natural gas price is very low there. However, energy is contributing. We got that headline PPI number coming in at double the month over month number. The year over year number came in at 1.6%, again, sharply higher than the 1.1% expected. And even core inflation, which strips out food and energy, even core PPI came in hotter than expected. We got 0.3% month over month. Again, energy was a big contributor. So when you strip out energy, about half of the inflation goes away, but still 0.3% higher than the 0.2% month over month the market was expecting. And even year over year core inflation at 2% was a little higher than the 1.9 the market was expecting. So the takeaway, guys, inflation, it's not surging. It's not mooning right now, but it is trending in the wrong direction. It's a couple of months in a row here that we've had inflation trending in the wrong direction. Ever so slight trend. It's not spiking. We're nowhere near the levels we saw like in August of 2022. But after a good year and a half of sustained moves lower in inflation, we saw it bottom out for a couple of months late last year. And now ever since December, January, we're watching that tick up in the wrong direction here. And by the way, while that's going on, the money supply is expanding again because the banks are loosening financial conditions. Everybody's trying to front run this Fed pivot that may or may not materialize anytime soon. And so inflation is coming back. And of course, asset prices are running like the blazes, as they often do. And well, inflation starts in assets, then it moves to consumer prices, and finally it hits wages. So, the writing is on the wall here, folks. There is a second wave of inflation that's on the way here. It may already be underway. And barring some kind of a big liquidity event in the bond market, maybe banks failing, a lot of debt going up in smoke, which we are seeing in commercial real estate. But barring an acceleration in that, it looks like inflation is going to continue trending up for the foreseeable future here. We also got retail sales came out. They were pretty good. We had earnings from Dick's Sporting Goods came in, same-store sales up 2.8%. It doesn't sound great, but when you keep in mind a lot of the inflation for sporting goods and apparel, which is what Dick's sells, those numbers have been flat to even negative. So to see same-store sales growing at Dick's, things actually looking pretty good for sporting goods there. Dollar General came out with a quarterly earnings report that was just kind of wasn't great. It was good, I would say. It was decent. We had some decent numbers at Dollar General. Now, when you compare to Dollar Tree's earnings that came out yesterday and the announcement that they were closing 1,000 stores, well, Dollar General looks really good. And so Dollar General stock is doing pretty good yesterday because it was dragged lower by those Dollar Tree earnings. And then coming out today, it was an okay, no announcement of hundreds or thousands of stores closing. So we're getting a little bit of a relief rally in Dollar General. We got initial and continuing jobless claims again today. A little bit of a downtick in initial claims. Continuing claims are continuing to tick up ever so slightly. So not any market moving information in the jobs market today, but we did get an announcement a few days ago that the Tyson Foods plant in Perry, Ohio is closing down. And that was an interesting story because you've got 1,300 jobs at that plant in Perry, Ohio that are going away. That factory shutting down, that is a town killer. The town of Perry only has a population of 1,600, which means pretty much everyone in town either works at that factory or works at some business that depends on the people who work in that factory for their business. So this plant closing, that is just absolutely a town killer in Perry, Ohio. We got another downgrade from Tesla, this time at UBS. A lot going on in the world today, guys. Why don't we just shrink my big melon of a head and get right into it? Don't forget that like button. And if you're new here, hit that subscribe button and have your coffee with the melon heads every morning as we go through the markets. Now, we went with the bull icon this morning because all the indexes were positive, and they still are positive barely, but the market is not liking that PPI report. PPI came out at 8:30 Eastern time. You can see it here on this candle. We had a big red candle down, bounce back, a little bit of volatility. Now we're gapping down again. S&P, though, as of this moment, is up 8.5 points ahead of the opening bell, or 0.16% higher. We've got the Dow is also still in positive territory, although giving up some gains off of that PPI report. Currently up 113 points ahead of the opening bell. Here's when PPI came out. Big red candle down, bounced a little bit, actually climbed for a few moments there. Now we're selling off again, but still in positive territory. And the NASDAQ, same deal. Although the NASDAQ not looking as good, up 33 points or 0.19% higher, but we've had a stronger reaction in the NASDAQ to the PPI versus the other indexes. And right now the NASDAQ is at the low of the morning, although still up 32 points. So not sure where stocks are going to open, if this negativity is going to continue through the open, or is this just going to be another one of those data points that the market shrugs off, right? Strong inflation print means bullish, weak inflation print means bullish, and no inflation print means bullish because, well, if the stock market is open, the stock market goes higher. That's pretty much how it works these days, and I'm sure that's going to end very well for everybody. Don't worry. Meanwhile, the dollar index, the DXY, is up 17 basis points this morning at 102.96, still below that all-important 103 level, but a little bit higher this morning. I'd expect a little bit of a stronger dollar here. Again, a hotter inflation print means potentially a more aggressive Fed, or a less dovish Fed, at least in the future. And so that would mean a slightly stronger dollar. We're getting that this morning. And we're also getting slightly higher interest rates this morning for the same reason. The 30-year Treasury is at 4.372. That's up 2 points and change this morning. The 10-year Treasury, 4.237. That's up 4.5 basis points. We've had a pretty good move in the 10-year over the last week or so here. We were down pushing 4.00 just a couple of days ago. Now we're at, pretty much 4.25 again. So small increases, no big spikes in interest rates, but these small increases are starting to accumulate here. Interest rates are trending back in the higher direction. Again, along with those inflation prints comes expectations of a more aggressive Fed, and thus interest rates respond accordingly to the upside. The 2-year Treasury is at 4.662. That's also up 4 basis points. And the 1 month is sitting unchanged at 5.38. Looking over at the commodities board, gold is not liking the stronger dollar or the higher rates this morning. April gold futures trading at $2,166. That's down about $14.60 this morning, about 0.2% lower. May silver futures at $25.19, up a couple of cents, or 0.14% higher. But again, not liking those higher rates and stronger dollar. Although silver's had a pretty good run here, recapturing the 25 level recently. Congratulations, silver stackers. Silver has largely sat out this big rally in gold, though. We've got gold at all-time highs. Silver nowhere near its all-time highs. So plenty of upside left on the table for silver should it decide to join in this rally that gold has seen. Meanwhile, platinum is down 1% and change. Palladium is up 1% and change. And West Texas Intermediate crude oil futures for the month of April back above $80, $80.69, up almost $1 this morning, or $1 or 1.22% higher. Most likely, we've got oil reacting strongly to this increase in consumption, this increase in inflation. That means higher energy prices. And talking about inflation and higher prices, Bitcoin taking a little bit of a breather this morning. Let's zoom in a little bit more here. Let's put this on daily candles. I should have done that before I went live. Here we go. Oh, look at that. A red candle for a change in Bitcoin, currently trading at $72,710, down about $400 this morning. Checking in with the Bitcoin ETFs, still having big time inflows into the ETFs. Looks like we had net inflows of somewhere around $800 to $900 million yesterday. People are still buying those Bitcoin ETFs. We've still got money leaving the Grayscale Trust and still entering largely the Fidelity and BlackRock ETFs, but virtually all ETFs still seeing net inflows here. People continue to buy the Bitcoin ETFs. The Bitcoin ETFs continue to bid up the price of Bitcoin as that happens, and Bitcoin price is responding, although taking a little bit of a break again this morning, down a few $100. Nothing goes up in a straight line forever. And let's see, moving on here to the PPI. This is the data that just came out about a half hour ago here. The producer price index for final demand in the United States rose by 0.6% month over month in February of 2024, marking the largest increase since last August and surpassing market expectations of a 0.3% advance. It didn't just surpass those expectations, it doubled those expectations. Goods prices rose by 1.2%. That's the most in 6 months, primarily driven by a 4.4% surge in energy costs and a 1% uptick in food prices. Now, that's interesting that we got a full 1% monthly uptick in food prices, because in our last CPI that came out just a few days ago, we had food prices were flat to negative month over month. So now we're seeing a big PPI increase in food, even though CPI isn't quite seeing it yet. That means margins for food producers are getting squeezed here. Additionally, the cost of services moved up by 0.3%. That's following a 0.5% increase from the previous month, with prices of transportation and warehousing services climbing 0.9% and those for trade declining by 0.3%. Meanwhile, the core inflation rate, which excludes more volatile items like food and energy, that increased 0.3% for the month, representing a slowdown from the 0.5% advance observed in January, but still slightly above the consensus of 0.2%. On a yearly basis, the producer price inflation accelerated to 1.6%. That's up from January's 0.9%, easily surpassing forecasts of 1.1%. So inflation, any way you look at it, guys, it's moving in the wrong direction. Now, here's looking at monthly. These are the month-over-month headline PPI prints. Not a lot you can see here. Obviously, making higher highs. Here's the high from back in August of 2023. We just matched that. Now, if you zoom out a little bit, if we go to like a 5-year chart here, you can kind of get a little bit of a better picture. Okay, through 2019 and 2020, PPI was trending up. We got a big spike in early 2022. Then it went negative as inflation started to level off and then actually started coming down. We saw PPI heading lower, and it has pretty clearly, though, put in a bottom here, and now it looks like it's trending back in an upward direction. And zooming out a little bit further to a 10-year chart, you can see where we're at here at 0.6%, well above the normal levels that we saw during the 20 teens here. So inflation is not going away, guys. That's the takeaway here. It's not alarmingly high, right? 3% inflation and CPI, 0.6% monthly inflation and PPI. It's elevated, but it's not like hide your kids, hide your wife kind of elevated. But it is moving in the wrong direction. It's that trend that is most worrying. And then looking at the year-over-year number, producer prices in the U.S. increased 1.6% in February over the same month from the previous year. So again, here you can see it was coming down all last year. We put in a bottom, we bounced a little bit, and now it looks like we're starting to move higher. When you zoom out again, you can kind of see the same thing. Okay, there was that huge, oh my goodness, inflation is out of control. PPI peaked year over year at 11.7%. Then it came all the way back down, but hey, again, look, it's not at an alarmingly high level, but it pretty clearly looks like it's starting to trend up, making higher lows and hopefully not anytime soon, higher highs. Inflation is moving in the wrong direction, guys, any way you look at it. Now let's talk a little bit about jobless claims. We also got that data today. The number of people claiming unemployment benefits in the U.S. fell by 1,000 to 209,000 in the week ended March 8th. That's below expectations of 218,000. So fewer people claiming initial unemployment. I got to be honest with you, this number doesn't really jive with what I've seen from a lot of the data about layoffs all over the economy. We still haven't seen those stories of layoffs show up in the unemployment benefits yet. But remember, you get things like severance pay and things like that. You don't go on unemployment until your severance goes away. So it's possible that those stories just haven't yet affected the numbers. The previous week's level was revised down by 7,000 to 217,000 from 210. Meanwhile, continuing jobless claims rose by 17,000 to 1.811 million in the previous week, compared to market expectations of 1.9 million. So we are seeing continuing claims continuing to rise, meaning people are having a harder time finding a job once they lose their job. And that's why people aren't quitting their job as often, because, well, it's just harder to find a new job here. Now, again, you don't really see a lot on this chart. We're kind of still within the noise of the chart on initial claims. If we zoom out a little bit, again, initial jobless claims, it's just not yet a problem, right? Here's that mess from COVID that we had, right? That came way down, and we've pretty much been trading flat for the last 2 years. So initial claims, not really telling us a lot. Now, continuing claims, however, that is telling us a little bit. Again, continuing claims rose to 1.811 million. Well below what the market was expecting, but they did still rise. And if you zoom out to a 3-year chart, okay, same thing, right? You got that COVID mess. And, as the market normalized from COVID, it came way down. But now you can kind of see, all right, we're making higher lows here. Definitely a ever so slight uptrend in continuing claims. And I think that's probably why we saw that increase in unemployment in our latest BLS data, because people who lose their jobs, some of them are finding new jobs, but a lot of them aren't. And so we're getting this slow and steady build in continuing unemployment benefits. And back to the ANIC data on job losses. Check this one out. In Perry, Ohio, Tyson Foods plant closure will have ripple effects in Perry. Perry's mayor said the closure of the city's Tyson Foods plant will have ripple effects across the community. The plant is the city's largest employer. The plant is set to close on June 28th, and this will leave 1,300 employees without a job. So 1,300 people in the town of Perry losing their job at this Tyson Foods plant that's closing. The town only has 1,600 people. And you got to keep in mind, guys, it's not just the plant closing that's going to cause job losses, right? Let's think about the diner that might maybe right down the street from the plant. I don't know if there's a diner right down the street, but I'm sure there is, hypothetically speaking, right? Well, that diner is going to see a whole heck of a lot fewer customers now that plant is closing, because people from the plant aren't going to go on their lunch break to the diner. The hotel in town is going to see fewer people, because maybe when maintenance work is done and technicians from out of town come to work at the plant, they would otherwise stay at the hotel. Well, that's not going to happen now. So the hotel is going to see a loss of business. The hardware store in town, the supermarkets in town, every satellite business around this plant is going to see a hit, and you're going to see a lot of job losses in this town. This is a town killer when something like this happens. And it's just sad to see this. And I would add, this is a meatpacking plant. I think they do pork at this plant here. We've got a real problem, a bottleneck in the meatpacking industry in the United States. And it's caused big problems for farmers and for ranchers. And to see more meatpacking plants closing at a time when there's already a bottleneck in the meatpacking industry, this is also bad news for farmers. Because, well, the farmers that are raising the pigs have fewer places to send the pigs to now, which means the final prices of pork in the supermarket might be heading higher, but the final prices that the farmers get for the pigs are going to be heading lower, because you have this dislocation in the supply chain. Now let's talk a little bit about retail sales. That came in today also. Retail sales in the U.S. were up 0.6% month over month. Hey, that's the same number as the PPI. That's following an upwardly revised 1.1% fall in January and below market forecasts of a 0.8% gain. The relatively modest increase, combined with a larger decline in January, suggests a potential slowdown in consumer spending. Bad news for the U.S. economy right there. A potential slowdown in consumer spending. We've been talking about that a lot. All these data from the retailers, Dick's Sporting Goods today notwithstanding, we've had a lot of bad quarterly reports from retailers over the last few weeks. And now the retail sales numbers are starting to match that. The biggest increases were seen in sales at building materials and garden equipment, up 2.2%. Motor vehicle and parts dealers were up 1.6%. Electronics and appliance stores were up 1.5%. Also, sales at gas stations rose 0.9%. Miscellaneous store retailers up 0.6%. Food and drinking places 0.4%. General merchandise 0.4%. and food and beverage stores 0.1. On the other hand, we saw declines recorded in furniture stores, clothing, health, non-store retailers, excluding food service, auto dealers, building material stores, and gas stations. The so-called core retail sales, which are used to calculate GDP, those were flat. So that's interesting because consumer spending has been a big contributor to the GDP growth that we've seen over the last couple of months. And now they're saying core retail sales were flat, 0.0. So that is going to be a drag on GDP growth. The American consumer is out of cash. He's in debt. Things are getting worse for him. Well, let's talk about some retailers then, shall we? This is the exception to what we just talked about. Dick's Sporting Goods shares are up 4.7% after earnings crush estimates, and the company offers upbeat guidance. I don't know that the estimates were crushed, but they certainly beat estimates. This was a pretty good report by Dick's Sporting Goods here. Dick's Sporting Goods stock rose early Thursday after the sporting goods retailer crushed estimates for its fiscal fourth quarter and offered upbeat guidance for 2024. Adjusted per share earnings came in to $3.85, well ahead of the $3.36 that FactSet consensus had. Sales rose 7.8% to $3.876 billion, also ahead of the $3.79 billion FactSet consensus. So pretty good sales. Same-store sales rose 2.8%, while FactSet expected 0.8%. Now let's talk about those same-store sales, 2.8%. That's below the rate of CPI, right? CPI just came in, 3.1%? The latest number, or 3.2, I forget already. I read so many of these data points. But same-store sales below the rate of inflation. However, if you open up the CPI report and you expand on the data and you look at some of the things like apparel inflation was 0.0% year over year in the latest report. If you look at things like sporting goods was actually negative in the latest CPI report. So you've got same-store sales are rising at Dick's Sporting Goods when the main things they sell, sporting equipment and apparel, are flat to negative. So you've got a lot more volume of sales going on at Dick's Sporting Goods. So yeah, this was a pretty good report here for them. Executive Chair Ed Stack said even without the extra week, the fourth quarter was the biggest for sales in the history of the company and helped drive gross margin expansion. So looking at Dick's Sporting Goods stock, it's looking pretty good this morning, up 8.25%, trading at $203.30. Up $15.50 this morning. So it looks like a pretty good day for Dick's shareholders. Now let's talk about one that maybe not so good. Dollar General forecasts upbeat 2024 sales on steady demand. The shares are up. Honestly, the numbers here in Dollar General weren't that good, but compared to Dollar Tree yesterday, they were excellent. So Dollar General forecasts annual sales above Wall Street estimates on Thursday, banking on more inflation-affected customers buying its cheaper groceries and essentials and sending its shares surging more than 6% pre-market. So there's that inflation squeezing the consumer again, something we heard about in the retail sales number. Dollar General is one of those stores that benefits from people trading down. When inflation hurts consumers and they can no longer afford to shop at more expensive places, they end up at a place like Dollar General and they end up seeing the benefits. Vasso's strategy to focus on basics like more employee presence at stores, greater customer engagement, and expanding private label brands has helped stabilize Dollar General's struggling business, which faces stiff competition from Walmart and Chinese e-commerce platform Temu. The strategy helped the discount retailer forecast 2024 sales to grow between 6 to 6.7%. That's above estimates of 4.4% growth. The retailer also posted holiday quarter net sales of $9.86 billion for the fourth quarter. That's above analyst estimates of $9.78. However, like rival Dollar Tree, Dollar General also projected annual profit below estimates, underscoring margin pressures from higher costs linked to its supplier chain, labor, and raw materials. In other words, Dollar General doesn't have pricing power. They're being squeezed by inflation like everybody else. Their shoppers are being squeezed by inflation, but they can't raise prices to keep up with that. If they raise prices, their sales are going to drop. And so their margins and their profits are falling a little bit. Gross profit as a percentage of net sales was 29.5% for the reported quarter. That's down from 30.9% last year. Dollar General's margins have also been pressured by the higher discounts and promotions it offered to clear its excess stock, along with retail shrink in which inventory is either lost, damaged, or, emphasis added, stolen. We have seen a surge of retail thefts across the U.S. in the last year. So Dollar General not immune to some of the inflationary pressures going on across the country. However, they are well positioned to benefit from those, and they're doing a heck of a lot better than the competition at Dollar Tree, and so they're gaining market share. And, well, this morning, Dollar General stock is doing pretty well, up 4.57% or $7.23 higher, trading at $165.40 this morning. Pretty good day for Dollar General. And the last one for today, UBS cuts Tesla stock price target to 165, down from 225. Man, they are just ganging up on Tesla right now. The former darling of Wall Street is now Wall Street's favorite punching bag as the EV bubble is bursting. And, well, Tesla was the EV bubble. On Wednesday, UBS, a global financial services firm, adjusted its outlook for Tesla, reducing the electric vehicle manufacturer's stock price target to 165, down from the previous 225. The firm has retained a neutral stance on the stock, citing a variety of concerns that may affect the company's market performance. In the the UBS analyst noted several key issues that it could impact Tesla's growth and margins. Among these, the potential delay in the launch of the more affordable Model 2. They're also perceiving the Model 2 is going to have smaller market share than the Model Y. Another concern is the dependency of margin improvements on the full self-driving feature, or FSD, which is currently mainly a U.S. product. The analyst suggests that Tesla might need to lower the FSD pricing to increase adoption rates, especially for the Model 2. If you're marketing the Model 2 to a more cost-conscious consumer, then you're going to have to lower the price of the self-driving feature if you want them to buy that also. Risks related to Tesla's operations in China were highlighted, along with the possibility that CEO Elon Musk may develop AI and robotics ventures outside of Tesla, something that he's actually said he was going to do in some of his interviews. And, of course, the thing that went on in court in Delaware with the pay package, that's going to encourage Elon to start other products in new companies that aren't subject to, say, Delaware courts, for example. And so Tesla, a lot of concerns from this analyst. They lowered the price target down to 165. I would add that's pretty much what Tesla stock is trading at right now, currently at 167.52, down another $2 or 1.16% lower this morning. That's after dropping 4.5% yesterday on the other analyst downgrade that we talked about in the stream yesterday. So they are ganging up on Tesla. No longer a darling of the market. The Mag 7 is now the Mag 6. Tesla is no longer the darling of Wall Street. And I just wanted to say thank you very much, Mr. Cole Marsh, who says, drink the coffee. It will make you feel better. I like the wake up juice, Cole. Thank you very much for buying me a coffee, sir. I appreciate that very much. And yeah, it does make me feel better. Or I should say, as I used to say in the office, I drink coffee for your protection. Anybody who comes by the desk with more work for Jack, yeah, coffee was for your protection. Anyways, we're no longer living the office life. Now we are doing the YouTube thing full time because we left the day job. And I just want to say thank you, Cole Marsh, again for the super chat and the support of the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. Thank you to all my Patreon supporters and channel members and magnanimous Melonheads out there. I got links to all that good stuff down below, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, until next time, live small and dream big.